how is the risk reward looking like for Asia versus the United States? Because some of the U.S. bulls out there are saying that it's looking actually better than back in February this year for when S&P 500 was at all-time highs, because, as you put it, slightly normal tariff environment. At least we know that we have some visibility, and we've got, of course, higher tariff numbers, but it is expected to come down, if anything. Back then, people were wondering what tariff number is going to be while watching S&P 500 go to all-time highs here. So is Asia looking better than the U.S., or is U.S. exceptionalism not dying just yet?
Actually, we think it's not going to be easy to reverse U.S. exceptionalism completely overnight. Our argument here is that much of the scare that happened in mid-April and the start of the market chatter about the end of U.S. exceptionalism is partly due to Trump's policies on trade, and we're now seeing the reversal of this. So certainly that's going to help the U.S. assets a bit in terms of relative performance. So we think that fear factor will begin to die down a bit as we go forward. So what we expect for the relative performance dynamic between U.S. assets and Asia-Pacific assets is that they're going to be roughly similar. In terms of the asset allocation and asset behaviors, equity markets and risk in these two regions will definitely perform better than the other asset classes. So that's what we're expecting here. Asia will benefit from the calming of the fears around the tariff. Many of these economies will face 10% tariff rate likely going forward. And we now have the 90-day truce between U.S. and China, and a lot of confidence-building measures between the two parties. So that's going to support the Asia market. And we think the setup is quite interesting for the region's equity and currency markets. But for the U.S. relative performance against Asia, we think it's going to be on par as we go forward, because we have seen a bit of correction and the portfolio rebalancing.
Okay, on par versus Asia and the U.S. versus Asia. What about specifically China? Because they actually had a nice run up until now, year to date. Where does it go from here? And do you need to be selective in terms of sectors at this point?
So definitely this Geneva deal was more positive than what we expected. Our base case was maybe the U.S. tariff rate on China eventually falling to 60% as a result of the bilateral deal. We actually gotten result that's better than that. And of course we're now seeing some reversals in export controls from China, and you could have potentially a corresponding measure from the U.S. And if we have if you have a Xi and Trump talk materializing, that they could certainly build market anticipation for a positive outcome for things like ADR delisting issues, and that permanence of the lower tariff between the two countries, the Section 232 tariff, as it's applicable to China. So these measures will start to get some positive catalyst potentially, and investors have to be open-minded about that. So for us, the Chinese asset performance will be more stable as we go forward. Now, can that outperform the other markets significantly? We don't think so. So what we're doing right now is that we're focusing on the overall emerging market complex, as opposed to staking everything on China's outperformance. So China will be stable enough to help the other emerging markets and other markets, but it might not significantly outperform because there are still some issues. Property sector is still soft, inflation is pretty low, the corporate pricing power is pretty constrained. So that issue still needs to be addressed. And so overall, part of the emerging market complex that will do well, but outperformance still a bit difficult in our view.